Macro market trends, stock selection, ETFs, options. Just some of the topics covered in Cook's Kitchen.
Kevin Cook here, running the kitchen solo today, and I'm asking the burning question, what is keeping bulls awake at night? Bunch of charts to look at. Let's look at some of the issues ahead of time here. All right, Russell 2000 is breaking down. That's keeping bulls awake. The Dow is bid, and so are staples. Johnson & Johnson, Procter & Gamble, healthcare. U.S. dollar seeing a flight to safety. The 10-year Treasury note seeing a huge flight to safety. Dow Transport's breaking down, and the SOX Semiconductor Index breaking down. We're going to look at least 4 of these issues right now. All right, Russell 2000, I showed this chart last Thursday at, basically looking at the fact that the IWM was about 13% above its 200-day simple moving average. That bothered me. We had a small position in TNA, the 3 times leverage bull for the Russell 2000, and we took that off the table just because I didn't like the way that this looked. Made me a little nervous. Where are we now? Well, the Russell 2000 is breaking down further this week. The IWM is below 92, and I'm looking for some support at 910, 91 there. But let's take a bigger picture look here. This is a 3-year weekly chart of the IWM versus the SPY. So this is a ratio chart, IWM over the SPY. And even though the IWM has led on this terrific rally to its new all-time highs, it's, historically speaking, it's not as overdone as early 2011 when growth stocks were very bid. Look at the ratio. IWM to SPY was over 0.635. And right now, this week here, we're pulling back below 0.60. So in historical terms, the ratio of your small cap growth stocks to the big caps is not that extended. But it is something we want to pay attention to. Russell 2000 obviously due for some kind of corrective action, get closer to that 200-day moving average maybe even test 900. All right, what's up next? Let's look at consumer staples. Incredibly bid. I mentioned Johnson & Johnson, Procter & Gamble. You look at Merck, Pfizer, Coke, General Mills. All these companies, have had a terrific bid to them. And is it just the flight to safety? Is this a rotation where we're hitting the small caps and big money's piling into the Dow blue chips for safety and yield? And is that a sign of an impending correction? So again, let's look at this on a 3-year weekly historical basis. I've got the ratio chart again, XLP versus the spiders. And once again, we are approaching some recent historical highs in that ratio where XLP becomes a greater portion of the spiders, up above 0.25 here. And I've got the S&P index in the background. You can make any of these ratio charts yourself, whether you go to stockcharts.com to do it for free or on whatever platform you have. Look at longer-term ratio charts because what they convince you of is that the market is all about rotation. Money isn't leaving the market and fleeing to cash and bonds. It's just moving somewhere else. And when you look at these ratio charts on a historical basis, you see that it's all about a relative value trade. If you pay attention to some hedge funds, that they call their MO relative value because they're always buying one thing and selling another, trading a spread, doing the relative value. Okay, so this chart may be indicating, your XLP versus your SPY, may be indicating that we are due for some corrective action as we get a little frothy up here above 0.25. And if you look at a chart of something like General Mills, it's off the hook. All right. Next up, let's talk about the dollar. This is a very long-term historical chart of the dollar going back to 1979, dollar index. And the bottom panel is correlation of the U.S. dollar and the S&P 500. Now, normally, these two things move in opposite directions. They tend to have a negative correlation. S&P up, dollar down, vice versa. We have crossed the line this year back into a positive correlation that is approaching plus 0.5. And this is on a 24-month rolling basis. So, this is something to pay attention to here. And you look at the top panel, is the dollar going to break out here above 85, which would be, a longer term would be a big move, big breakout for the dollar. But this is, again, this is really all a function of the euro currency. The euro currency is 58% of that basket of 6 currencies, which makes up the dollar index. So weak euro always makes a strong dollar. And right now, with Europe continuing to get weak and more worries about contagion, which doesn't affect our stock market, it's still going to affect our dollar. Sell the euro, and that translates into a stronger dollar. And you want to pay attention to this move. I've always said that the euro can be a tell for the stock market, but it's always been the weakest follower of risk appetite. So I wouldn't put too much credence into it. The dollar bid here is more of a hedge. Hey, get out of Europe. All right, let's take a look at our last chart, the bonds. This is TLT, good proxy for looking at long-term treasuries. And here, here's a market that I've been trying to short via the TBT, and it's not working out that well right now. You've got TLT, the Treasury is bid. You got the 10-year back below 1.85%. Now, is that a sign of fear in global markets where large investors are piling back into Treasuries and forcing that yield up? It could be. It very well could be a positioning for safety. So while lots of people talk about the great rotation out of bonds into stocks, really what you have is a short-term rotation here back into the bonds, and it could be a sign of, hey, let's take some cash out of stocks, park it here for safety. Another big picture thing we want to keep in mind here, though, is that maybe fair value for the 10-year Treasury is 2%. While we'd all expect the bond bubble to burst and see the 10-year Treasury rocket up to 2.5%, 3%, right now you've got a Fed put that's in place till 2015. And that Fed put might keep the 10-year Treasury under 2%. So we don't have time to look at the SOX yet. That's one you might want to look at. The transport's breaking down a little bit. All these things speak of a possible short-term correction, but really the long-term bull trend is still intact here, and I think you want to be buyers of any 3 to 5% dips we get. All right, I'm Kevin Cook. Thank you.